So, good morning or good afternoon, dear ladies and gentlemen. It's my sincere pleasure to welcome you to today's webinar, hoping you all had a pleasant start into this still quite new year, 2023. The Malaysian Budget 2023 has just been retabled on Friday, 24 February. It will take into account the current economic challenges, of course, while at the same time focusing on measures promoting the country's competitiveness and sustainable economic recovery. During this webinar, my dear colleagues will discuss the budget's focus areas, Malaysia's proposed investment plans and budget allocation, as well as key tax and incentive proposals. Your major takeaways from this webinar should be a sound understanding of Malaysia's position and direction to ensure sustainable economic growth, and how the proposed investments, budget allocation, and of course tax proposals are likely to affect you and your business in 2023 and onwards. Though we probably all had our fair share of digital meetings, let me quickly guide you through the technical side of this program. In the top right corner of your screen, you will find the control panel. Here you may adjust the audio settings and choose between your headset or the computer audio. Please note that as an attendee, you are muted by default. So if you want to enjoy a sip of coffee, just feel free to do so anytime. A little further down, you will find the most important part of this control panel, which is the question panel. Please insert all your questions or comments here for us to take care of. You may do so anytime during the session and of course refer to topical questions, which we will take down and happily refer to afterwards in our Q&A session at the end of the webinar. While you may also insert any technical hiccups you might experience, which of course we don't hope so, but might happen. And I will be happy to attend to these immediately, of course, and hopefully fix whatever comes up. So please know that this webinar will be recorded and made available online for you and your colleagues to recap anytime you wish later online. Looking forward to a most enlightening session. It is now my pleasure to leave the stage to my dear colleague, Priya Selvanathan. Priya, the stage is yours.
Thank you, Bettina. And thanks everyone for joining today on our webinar on the Retable the Budget 2023. Can we go to the next slide, please? So the agenda for today will be briefly looking at the economic outlook for 2023. And then my colleagues will discuss the budget touch points and some of the key tax proposals that were announced in the budget. And then finally, we'll round out with a short discussion on the global minimum tax rate. Next slide. So on the economic outlook for 2023, the retabled budget for 2023 is the first budget under the new unity government that takes a more balanced approach towards addressing the well-being of the public, particularly the B40s and the M40s that have been severely impacted by the depressed global economy. It also looks at how to support small and medium enterprises, as well as to build the resilience of Malaysian businesses and continue to focus on attracting foreign investments. With a budget allocation of 386 billion Malaysian ringgits, this is the largest budget to date. The revenue is expected to be slightly lower in 2023 at about 291 billion Malaysian ringgit, while the fiscal deficit is expected to narrow to about 5% of GDP. That's compared to 5.6% in 2022. Following the sharp decline in economic growth in 2020 due to the pandemic, 2022 saw quite a significant GDP growth of 8.7%. And this was driven mainly by increased domestic demand that resulted from household spending, investments, and tourism, as well as an overall expansion in most economic sectors. However, in 2023, the GDP growth is expected to moderate to about 4.5%. And this is due to an overall global economic slowdown that we're already starting to see the effects of. Next slide. And as you can see from this slide here, in 2022, most sectors recorded a growth. A particularly big one was the service sector, which rose to 10.9%. That was mainly due to the rise in domestic retail activities, tourism activities, and the recovery of trade. The manufacturing and service sector will continue to remain as a major contributor to the Malaysian economy. However, the growth is projected to be moderate compared to 2022, and this is, as I mentioned previously, due to the overall global economic slowdown. So that would be, in a nutshell, what we can expect in terms of the economic outlook for this year. And now I will pass it on to my colleague Vivian, who will take you through some of the budget highlights and some of the tax proposals.
Priya. So, hi everyone, I'm Vivian. So I will continue with the webinar and we will now discuss on budget touchpoints. Okay, so the theme for budget 2023 is building Malaysia Maju, in which it focuses on 12 main efforts that aims to address pressing issues of the country, such as driving comprehensive and sustainable economy, overcoming economic challenges, meeting needs of the nations, driving the country growth, and as well as to attract high investment. So the first agenda of the budget focuses on driving a comprehensive and sustainable economy, and the effort includes fiscal sustainability, fulfilling the right economic needs, managing natural disasters, as well as attracting high impact investment. So moving on to the second agenda, which focuses on institutional reform and good governance to restore confidence, and the efforts include refreshing the public sector, strengthening public-private partnership, prioritizing the digital agenda, strengthen the role of government agencies and government-linked companies such as highly innovative startups and also corporate social responsibility. And lastly, third agenda on social justice for reducing inequality, such as eradicating hardcore poverty, reducing the cost of living, ensuring harmony and unity, and providing quality-based needs such as education, healthcare, housing, and so on. So the budget outlines several updates on various existing tax measures as well as other new tax proposals. So we'll now continue to present and discuss on the key tax proposals for the budget 2023. Okay, so under corporate income tax, so we'll now discuss on the reduction of income tax rate for SMEs. So currently, the chargeable income for SMEs for the first 600,000 ringgit is taxed at 70% of corporate income tax rate, and the remaining chargeable income is taxed at 24%. It is proposed that income tax rate for the first 150,000 ringgit chargeable income for SMEs be reduced by 2%, that is from 17% to 50%. And the income tax rates for the remaining chargeable income be maintained at 17% and 24%. So let's look at the table. So for the first 150,000 ringgit chargeable income, it will be taxed at 15%. Then from 150,001 ringgit to 600,000 ringgit will be taxed at 17%. And then the remaining chargeable income, which is exceeding 600,000 ringgit, will be taxed at a prevailing rate of 24%. So the tax benefit for SMEs will be up to 3,000 ringgit per year. So we'll move on to the next slide. So now we'll be discussing on the tax deduction for renting private electrical vehicles. So it is proposed that the company that rents non-commercial, which is private, electrical vehicles be given tax deduction on the rental amount up to 300,000 ringgit from year of assessment 2023 to 2025 to encourage the use of low carbon vehicles. Okay, moving on will be the tax deduction for sponsorship of smart AI-driven reverse vending machine. So it is proposed that tax deduction be given to companies, individuals, cooperative partnerships for donations or sponsorship of smart AI driven with the reverse vending machine. This was proposed to support the recycling of plastic waste ecosystem, ensuring that the recycling rate collection be increased through recycling waste program. And this incentive will be made effective for contributions and sponsorship application received by the Ministry of Finance from 1st April 2023 to 31st December 2023. Okay, moving on to the next slide. Okay, so next we will talk about the tax reduction and tax exemption for food production projects. So it is proposed that the existing tax reduction and the exemption for food production project is extended to 31st December 2023. That is for application received by the Ministry of Agriculture and Food Security from 1st January 2023 until 31st December 2023. So under tax reduction, companies investing in subsidiary engaged in food production project is given a tax reduction equal to the amount of investment made in the same basis year. And under tax exemption, for companies engaging in new food production project is given income tax exemption of 100% on statutory income for 10 years of investment, or companies engaging in expanding food production project is given income tax exemption of 100% on statutory income for 5 years of investment. This scope is also expanded to include agriculture-based projects on controlled environment agriculture. Move on to the next slide. Okay, so we now discuss on the tax reduction on cost of living in Bursa, Malaysia. So it is proposed to have an extension of the existing tax reduction on cost of listing on the ACE, Asset Certainty Efficiency, and lead markets of up to 1.5 million ringgit from YA 2023 to YA 2025. Tax reduction is also expanded to include cost of listing technology-based companies in the Bursa main market. Okay, next will be on the tax reduction on issuance of Sri Sukuk. So it is proposed that tax reduction on cost of issuing Sri Sukuk approved, permitted, or deposited with the SSM be given for 5 years. That is from year of assessment 2023 to 2026. So the next slide. So on the double deduction for childcare. So double deductions were given to employers with effect from year of assessment 2013 for providing and maintaining childcare centers, and also for providing childcare allowances to the employees to encourage more employees to provide childcare centers for their employees. So it is proposed that double deductions to be maintained until further notice. And the next will be on the tax reduction for employment of former national athletes. So it is proposed that tax reduction be given to employers to encourage hiring of former national athletes in order to safeguard the welfare of former national athletes. However, further details on the tax reduction were not announced. So the next one will be discussing on the expansion of scope of the tax reduction for employment of senior citizen, extra-dependent, ex-COVID parents, and also supervised person. So to encourage employers to employ valuable talent from other neglected social care segments, it is proposed to expand the scope of tax reduction from the remuneration of employees paid to inmates and ex-inmates of Henry Garner School under Malaysia Concerned Department, Protection and Rehabilitation Institution, or the NGOs registered under the Social Welfare Department, effective from year of assessment 2023 to 2024. Okay, move on to the next slide. Okay, so on tax reduction for contribution made through FINA. So to support the arts and culture industry, it is proposed that tax reduction be given for contribution made to the Tabung Community Film and the Pembangunan Film Kenegaraan under FINA. Only clarification, however, is required on the conditions of tax reduction. Okay, and the next one will be talking about the tax reduction for expenditure on Malaysian handicraft. So it is proposed that tax reduction will be given on purchase of qualified Malaysian-made handicraft products of up to 150,000 ringgit from local handicraft entrepreneurs registered with the Malaysian Handicraft Development Corporation from January 2023 to November 2025. So moving on, so we will next be discussing on the proposed tax incentive for this budget. So the first topic for this is on the new industrial master plan, NIMP 2032. A new industrial master plan 2030 will be announced in the third quarter of 2023 to outline the direction for development of an industry that focuses on high quality activities and recruitment of local talent. So in accordance with this plan, the investment promotion agencies and also incentives will be restructured towards a tiered tax rate incentive, which is outcome based on high value employment, degree of integration of local supply chain, and creation of the industrial cluster. So the monitoring of companies which has been granted tax incentive will also be strengthened so to ensure that the country is the benefit from it. So next, the next slide, we will discuss on tax incentive for carbon capture and storage. In respect of the CCS technology, tax incentives are offered to recognize CCS activities as a new source of economic growth and in achieving net zero greenhouse gas emissions. So the tax incentives proposed for companies undertaking CCS in-house activities include the investment tax allowance of 100% of qualifying capital expenditure for 10 years to set up against 100% statutory income. Then full import duty and sales tax exemption on for CCS technology commencing from 1st January 2023 until 31st December 2027. And tax reduction for allowable pre-commencement expenses within 5 years prior to the date of commencement of operation. So next, tax incentives proposed for companies undertaking CCS services include investment tax allowance, 100% of qualifying capital expenditure for a period of 10 years to set off against 100% of business statutory income, or tax exemption of 70% on statutory income for a period of 10 years, and full import duty and sales tax exemptions on equipment used for CCS technology from 1st January 2023 to 1st December 2027. For companies using CCS services, they will be given tax reduction on fees incurred for the use of such services. So the tax incentive is made effective for application received by the Ministry of Finance from 25th February 2023 to December 31st, 2027. Okay, moving on to the next slide. Okay, so now we will discuss on the tax incentives for manufacturers of electric vehicle charging equipment. So the proposed tax incentives are 100% tax exemption on statutory income from year of assessment 2023 to year of assessment 2032, or 100% of investment tax allowance on qualifying capital expenditure incurred for a period of 5 years to set off against 100% of statutory income for each year of assessment. This will be made effective for application received by MIDA from 28 February 2023 to December 1st, 2027. So this was proposed to attract high value investment in manufacturing of electric vehicles, charging equipment to use the electric vehicle ecosystem. So next we will discuss on tax incentives for relocation to Malaysia. So it is proposed that tax incentive be extended for 2 years up to 31st December 2024. These incentives comprise special tax rate of 0% for up to 15 years, or 100% investment tax allowance for 5 years for qualifying companies in the manufacturing and selected service sectors. So based on this, budget could cover also the electrical and electronic E&E sector. So move on to the next slide. Okay, so now we discuss on the tax incentives for aerospace industries. So existing income tax exemption and investment tax allowance for companies in the aerospace industry is proposed to be extended for 3 years. That is for application received by MIDA by December 31st, 2025, in line with the Malaysia plan to transform Malaysia as a key player in the aerospace industry. So the tax incentive includes income tax exemption of 70% to 100% for a period between 5 to 10 years, or investment tax allowance of 60% to 100% for a period of 5 years, and to be set up against 70% to 100% of statutory income for each year of assessment. So this would be for new companies. And for existing companies, the tax incentive includes investment tax allowance of 60% for a period of 5 years, and to be set up against 70% of statutory income for each year of assessment. Okay, move on to the next slide. Okay, so now we'll be discussing on automation capital allowance on tax incentive for automation in manufacturing, services, and also the agriculture sector. So companies under the manufacturing and services sector incurring qualifying capital expenditure on automation equipment are given tax incentive under two categories. That is category 1, which is companies involving on the labor-intensive industry, for example, rubber, textile products, wood, plastic, are given 100% accelerate capital allowance (ACA) for automation equipment on the first 4 million ringgit for qualifying capital expenditure incurred, in which can be fully utilized within 1 year. And then under category 2, which involve companies in industries other than category 1, which includes service sector, will be given ACA of 100% for automation equipment on the first 2 million ringgit for qualifying capital expenditure incurred, and this can be utilized within 1 year. And both categories are also eligible for income tax exemption equivalent to 100% of qualifying capital expenditure incurred for the automation equipment. Thus, 200% of capital expenditure can be eligible to claim within a year. So in this budget, it is proposed that the automation capital allowance for automation equipment be enhanced as follows, which is to expand the scope of automation to include adaptation of industry 4.0 elements, expand the scope of tax incentives is to include agriculture sector, and increase the capital expenditure threshold up to 10 million ringgit for categories 1, 2, and agriculture to be aligned. So moving on to the next slide. So for tax incentives for ship building and ship repairing industry, SBSR. So existing tax incentive for SBSR is extended for 5 years, that is for application received by MIRA by December 31st, 2027. So the tax incentives include for new company, finance status with income tax exemption of 70% to income for 5 years, or investment tax allowance of 60% on qualifying capital expenditure including 5 years to be set up against up to 70% of the statutory income for each year of assessment. And then for existing company, the investment tax allowance of 60% on qualifying capital expenditure incurred within 5 years to be set up against up to 70% of the statutory income for each year of assessment. So moving on to the next slide. Tax incentive. So this will be discussing on tax allowance for data centers. So the government mentioned that they will ensure more data centers to set up operations in Malaysia by providing tax incentives, secure infrastructure, green energy, and also suitable locations. However, further details on this incentive were not announced. Then lastly, on the tax incentive for chicken rearing in closed house. So it is proposed that tax incentive for chicken rearing in closed house systems be given to encourage more chicken rearers to adopt a environmental friendly closed house system, as well as to increase productivity from year of assessment 2023 to 2025 to 2025. So the tax incentives to be given are 100% of accelerated capital allowance on the qualifying capital expenditure and income tax exemption of 100%, equivalent to the qualifying capital expenditure. Thus, qualifying capital expenditure that can be claimed within a year amounts to 200. So now I will pass the time on to my colleague, Del, in which she will be talking more on the rest of the. Thank you.
Thank you, Vivian. I hope all of y'all can hear me loud and clear. So I will be taking you on to the personal income tax topic now. So in Malaysia, a resident individual is taxed at a progressive rate between 0 to 30% on their chargeable income. A Malaysian non-resident will be taxed at a flat rate of 30% on the total chargeable income. So you will be considered a non-resident if you spend fewer than 183 days in Malaysia during a year of assessment. So the government, in dealing with this high cost of living and to increase disposable income among middle income rakyat, the government has proposed that the resident individual income tax rate to be reduced by 2% for each chargeable income band between 35,000 to 100,000 ringgit. To make the individual income tax structure more progressive, the government has proposed that the income tax rate for resident individuals at the chargeable income band of 100,001 up to 250,000 be increased by 1%, while the chargeable income band between 250,001 ringgit up to 400,000 ringgit be increased by 0.5%. For chargeable income band between 400,000 ringgit and 1 up to 600,000 ringgit, the tax rate is proposed to be increased by 1%, from 25% to 26%. Meanwhile, the chargeable income band between 600,000 and 1 ringgit up to 1 million will be increased by 2%. For context, the RM 100,000 ringgit refers to an average monthly earning of approximately 9,000 ringgit up to 11,000 ringgit, depending on the eligibility for the various personal reliefs. So the reduction gives tax savings up to 1,300 per annum for individuals who are below the chargeable income of 100,000. As per the budget announcement, the chargeable income band between 100,000 to 1 million, this increase would result in additional tax payable by only a small group of taxpayers, which is estimated to not exceed 150,000 individuals who are expected to pay not more than 10,950,000 ringgit per annum as additional tax. Moving on to the next slide. So the tax relief for medical treatment expenses. Currently, the income tax given on medical treatment expenses up to 8,000 ringgit, for example, for serious illnesses for taxpayer, spouse or child, fertility treatment for taxpayer or spouse, and few others. Effective YA 2023, to ease the financial commitment on early intervention for children with learning disabilities, the government has proposed that the scope of tax relief up to 4,000 for medical treatment expenses be expanded to include intervention expenditure for autism, ADHD, intellectual disability, Down syndrome, and few others, where it has been diagnosed, the diagnostic assessment is certified by the medical practitioner who is registered by the Malaysian Medical Council, and the early intervention or the rehabilitation program is conducted by a health practitioner registered under the Allied Health Profession Act. So with this expanded scope, the amount of tax relief for medical treatment expenses has increased from 8,000 ringgit to 10,000 ringgit. So for the tax relief for fees paid to childcare center and kindergarten, tax reliefs of 3,000 ringgit to individual taxpayers who enroll their children aged up to 6 years old in childcare centers also known as TASCA, registered with the Social Welfare Department, or child centers where it's registered with the Ministry of Education Malaysia, also known as TADIKA, has been extended for another year, effective YA 2024. Moving on to the next slide. Tax relief for life insurance premiums, takaful contribution of life insurance policy. Individual income tax relief is given on contribution to approved provident funds such as the EPF, takaful, or life insurance premium payments. To further encourage voluntary contribution to increase savings in preparation for old age, the scope of this tax relief is to be expanded to cover contributions to EPF made voluntarily by individuals or pensional public servants up to 3,000 ringgit effective YA 2023. Concessionary tax rate for C-suite in the E&E sector. So the government had previously introduced the tax incentive for eligible manufacturing companies that relocate their operations to Malaysia. This concessionary rate of 15% is extended until 2024 for individuals holding C-suite positions in companies in electrical and electronic sector that relocates their manufacturing operation into Malaysia. But this is subject to meeting the conditions. The conditions are the individual should receive a monthly salary not less than 25,000 ringgit, and the individual must be a Malaysian tax resident for each YA throughout the 5-year period. Moving on to the next slide. So the Prime Minister has proposed to expand its tax base by introducing luxury goods tax for items such as branded watches and fashion items, starting this year with a certain limit according to the type of luxury goods. Luxury tax is a sales tax or surcharge levied on certain products or services that are deemed non-essential or are only accessible to the wealthiest consumers. Earlier last week, the Deputy Finance Minister mentioned that the government will implement luxury goods tax by second half of this year once the definition, rate, and the coverage has been fine-tuned. Moving on to the next slide. Extension of the tax incentives to support the development of EV industry. So to spur the domestic demand and encourage the growth of locally assembled EV activity, the government has proposed to extend this tax incentive for import duty, excise duty, and sales tax exemption given to imported complete build-up and complete knockdown components, CBU, CKD, and locally assembled EV, as shown in the table. The tax exemption for EV consists of passenger vehicles, including SUV, MPV, commercial vehicles, and motorcycles. Moving on to the next slide. Imposition of excise duty on liquid gel products containing nicotine. The government planned to impose excise duties on liquid or gel products containing nicotine, usually used in the electronic cigarettes and vape, and where the revenue collected for this, half of it will be allocated to the Health of Ministry. Excise duty is currently levied on alcoholic beverages, tobacco products, passenger motor vehicles, and playing cards. Presently, the liquid or gel products containing nicotine used in e-cigarettes and vape are not subject to excise duty. However, nicotine-free liquid and gel products are currently subject to excise duty at 40 cents per liter. Electronic cigarettes and vaping are currently widely used in Malaysia, despite being technically illegal. It appears that the budget announcement entails review of the health regulations to curb illicit sale of these products while concurrently collecting excise duties. Moving on, import duty sales tax exemption on nicotine replacement therapy. Smoking cessation services at the government health clinics and hospitals has been implemented since 2000. Starting 2015, the service has been expanded to the private health facilities, including hospitals, clinics, pharmacies, throughout public and private collaboration under the MQUIT program. In this program, the NRT is used as one of the medical treatment options for smoking cessation. So as such, to support the MQUIT program and to encourage the use of NRT as an option for smoking cessation, it is proposed that the import duty and sales tax exemption be given to nicotine gum and nicotine patches for a period of 3 years. Import duty and sales tax exemption on studio and filming production equipment. Currently, the importation of specific equipment for creative industries such as cameras and broadcast equipment, audio and video systems, studio equipment, filming production equipment is all subject to import duty between 5% to 30% and sales tax of 10%. In order to boost the level of the creativity of the industry players in creating high-value creative content in the domestic and international markets, as well as attracting foreign films producers to carry out filming activities in Malaysia, it is proposed that import duty and sales tax exemption on studio and filming production equipment to be given to the providers of studio equipment production and post-production services for a period of 3 years. This would be effective from 1st April 2023 until 31st March 2026. Review of excise duty and sales tax exemption on the sale of transfer of the individually owned taxis and hired cars. In the budget 2012, excise duty and sales tax exemption were given on the sale or transfer of individually owned budget taxis and hired cars, where the age of the vehicle must exceed 7 years from the date of registration. However, in the recent budget, it is proposed that the excise duty and sales tax exemption be expanded to include executive taxi and Taxi One Malaysia and airport taxis. And the qualifying age of the vehicle must exceed at least 5 years from the date of registration. Let's move on to the next slide. For the first-time residential home buyers. First-time residential home buyers are granted a 75% exemption of stamp duty on both the instrument of transfer and loan agreement for properties worth 500,000 ringgit to 1 million. This exemption is until 31st December 2023, and it's independent of the full exemption presently given for the first time residential property worth below 500,000. Stamp duty treatment for the transfer of property by way of love and affection. Prior to 1st April 2023, stamp duty remission of 50% is given on the instruments of transfer of property executed between parents and children of Malaysian citizenship. Effective from 1st April 2023, in order to reduce the costs of stamp duty for transfer of property by way of love and affection between parents and children, grandparents and grandchildren, it is proposed that stamp duty on the instruments of the transfer of property to be fully exempted. However, it's limited to the first 1 million of the property's value. The remaining balance of the property's value is subject to an ad valorem rate, and it's given a 50% remission on the stamp duty imposed. This stamp duty treatment applies to recipients who are only Malaysian citizens. Stamp duty treatment for the educational loan or scholarship agreement. Effective 1st June 2023, to streamline the stamp duty treatment for all levels of education, the government has proposed to impose a fixed duty of 10 ringgit be expanded to include education loan or scholarship agreement to pursue education at all levels, including certificate where it's education skills professionals in any educational and training institutions. Currently, stamp duty is imposed at 10 ringgit for educational loan or scholarship agreements to pursue tertiary education, for example, diploma and above, at higher learning institutions, while other levels are still charged at the ad valorem rate. Extension of stamp duty on the restructuring, rescheduling of loan of the financing agreement. Full stamp duty exemptions is given on restructuring or rescheduling of loan or financing agreement between borrowers and the financial institutions executed where the original loan or the financing agreement has been duly stamped, and restructuring or the rescheduling of the loan or the financing agreement does not have the element of an additional value to the original amount of the loan or financing. So to reduce the cost of borrowing and to improve borrowers' cash flow, the government has proposed to extend that the stamp duty exemption on restructuring or rescheduling of a loan or financing agreement be extended from the 1st of January 2023 until 31st December 2024. Moving on to the next slide. Reintroduction of the Special Voluntary Disclosure Program. This program was previously introduced in 2018 by the Malaysian tax authorities. This program is expected to encourage taxpayers to be in compliance and to increase revenue for the government. Effective from 1st June 2023 to 31st May 2023, individuals or companies will be granted 100% penalty remission to make a voluntary disclosure in good faith for any duty or penalty liabilities that remain outstanding. As such, companies should review their tax compliance to determine if there's any instances of tax underestimated, underpaid, or erroneously reported. The proposed introduction of capital gain tax in Malaysia. The government will conduct a study on introducing tax on capital gains from YA 2024 on the disposal of unlisted shares made by companies at a low tax rate. The Prime Minister suggested that this proposal will be enacted after consultation with the relevant stakeholders in greater detail. As we understand, Malaysia currently does not impose capital gains tax except for real property gains tax, which is applicable to gains on disposal of real property or shares in real property up to 30%. We will need to see if the government will introduce a new legislation on this capital gains tax, or whether the government will amend the RPGT legislation to include the sale of shares of unlisted companies, or it will be added within the Income Tax Act by defining it so it can include the certain capital gain tax which can reportedly be reported annually. Capital gain tax are generated on a passive basis with very little value add. An example would be an asset that would have been held for a long time and therefore sold for a gain. Usually the beneficiaries of such gains are rich individuals or corporations that have the capacity to hold such assets. In Asia, Singapore and Hong Kong are the two largest financial markets close to Malaysia to not impose capital gain tax currently. However, other ASEAN nations such as Indonesia, Thailand, Vietnam all have capital gain tax. Now we'll move on to the next slide, and Priya will carry on from this. Thank you.
So now I'll just spend a few minutes to take you through this new thing called the Global Minimum Tax Rate. So Global Minimum Tax, or GMT for short, is supposed to be the next big thing that is going to have quite a big impact on taxpayers. There was no announcement in relation to the implementation of GMT in the budget speech, but the Ministry of Finance has indicated in the budget touch points that Malaysia will be implementing the GMT based on the OECD Pillar 2. So the GMT was introduced by the OECD with the aim of ensuring that multinational companies pay the right amount of taxes. And what has been decided is that that is a minimum tax of 15%, regardless of where they operate. And this applies to MNCs that are operating in at least 2 jurisdictions with an annual consolidated group revenue of at least 750 million euros in at least 2 of the 4 immediately preceding fiscal years. So if your effective tax rate is less than 15%, there may be top-up taxes imposed in the foreign jurisdictions via an income inclusion rule or a UTPR rule. In Malaysia, we are likely to see that Malaysia will implement a qualified domestic minimum top-up tax, which will grant the right to collect the top-up tax to Malaysia, instead of Malaysia ceding the taxing right to the foreign jurisdiction, as is the case under the IIR or the UTPR. The GMT was originally planned to be implemented in 2023, but this has now been delayed to 2024 because of its complexity. In fact, some jurisdictions like Singapore and Hong Kong have also announced that they will delay the implementation further to 2025. As of now, we don't yet know when Malaysia will implement the GMT, whether it will be implemented in 2024 or whether it will be further delayed. Can we move to the next slide? And since the OECD issued the Pillar 2 GLOBE model rules in December 2021, and the commentary on the GLOBE model rules in March 2022, Malaysia has since then actually taken a very proactive approach towards their stance and their view on implementing the global minimum tax rate. Whilst our neighbors in Singapore and Hong Kong took a little bit longer to take their stance on this, Malaysia took a very proactive approach towards this. And in 2022, the Ministry of Finance issued a statement that the implementation of GMT was being reviewed. This was closely followed by a public consultation on the implementation of these rules. The original budget 2023 that was announced in October 2022 last year included an announcement that Malaysia does plan to implement the GMT via the qualified domestic minimum top-up tax in 2024. However, there was no mention of this in the retabled budget, as it did not specifically mention the implementation of GMT. It was, as I mentioned, only mentioned in the budget touch points. So it is quite inevitable that GMT will be implemented in Malaysia. The main question now is just when. So, and if GMT is going to be implemented, it should be announced, sooner rather than later, to give taxpayers sufficient time to prepare and ensure that they have the proper internal controls to manage this process. The implementation of GMT is not going to be straightforward and will require some time for taxpayers to transition, to make sure that they have the proper internal controls and reporting requirements. Next slide. And finally, as I mentioned, this implementation of GMT is not going to be a simple process or a very straightforward process. So even though Malaysia hasn't mentioned an implementation date, I think we can all bear in mind that perhaps 2024 will be the first year that this will be implemented, given that this is the implementation date of the OECD. And there will likely be quite some significant impact to Malaysian taxpayers. One of the first impact to possibly hit companies is on the impact on the company's cash flow. Top-up taxes, especially if it's significant, could affect the repatriation strategy of companies. the application of these rules and the jurisdiction implementation timeline has to be considered in the collecting jurisdiction as well. There could also be an impact on a company's bottom line. For example, the implementation of GMT will likely require additional costs to fulfill reporting requirements. And taxpayers also need to consider their dividend payout strategy, as well as the impact to their pricing strategies. Another thing to consider is the relevance of tax incentives. Once the GMT is implemented, you need to consider whether tax incentives would actually still be beneficial to you as a taxpayer. And it'd be important to seriously consider what type of incentives should be considered and whether the benefits of these tax incentives outweigh the costs. Finally, the implementation of GMT is likely going to require a lot more reporting requirements from taxpayers. So you will need to appraise your data readiness, and this will likely take some time. So whether your systems and your processes are able to extract the information required for the GMT reporting purposes, and whether you have the available resources in terms of your people and your expertise, and this is likely going to, again, take some time and effort from the taxpayer side. And you would also need to consider the impact of this reporting on your accounting and financial reporting. So all in all, there is still quite a lot of uncertainty on the relevant rules for GMT and how it's going to be implemented in Malaysia and when it will be implemented. So taxpayers, you should start preparing now to ensure a smooth transition. And on the regulator side, we do hope that there will be more details that will be made available soon to ensure that there is a smoother process towards implementing of the GMT. And that is all we have for today, and we'll be happy to take some questions.
Thank you very much, Priya. Thank you very much, Dal and Vivian, for this very comprehensive insight into Malaysia's budget 2023 and the manifold tax proposals coming up. Yeah, I'm sure there was a lot to take in, but here we are with some questions that I'd like to hand over to you. First one would be, what are your thoughts on introducing luxury goods tax in Malaysia? That was, I think, one of Dal's points.
Yeah, sure. I will address this. So yeah, I will get this. So luxury good tax has been implemented in several countries, including China, Indonesia, Thailand, South Korea, India, Canada, and a few others. But however, it's very different from the scope and mechanism and how it's taxed. In some cases, the tax rate is a flat percentage, while others could be a progressive percentage. For example, where the value of the item increases, the tax rate increases. It remains to be seen whether Malaysia's proposed luxury tax on goods would be given effect by way of higher sales tax rate for certain goods, or expansion of the scope of excise duty rate, or by way of a new tax law altogether. The implications of this tax on a consumer behavior. So this will actually encourage all the consumers, for example, like for us, to delay buying any goods, luxury goods in Malaysia, for example, until we travel overseas, and then we'll buy it from overseas. So this can have a consequential impact on the Malaysian retailers. So that's why the government should carefully consider prior to implementation of this act. So also, it remains to be seen whether there would be a refund mechanism for tourists who purchase goods for consumption overseas. Given that most countries have tourist refund scheme in place, a similar mechanism may be pertinent for the competitiveness of Malaysia's tourism and luxury retail sector. Yeah, I hope that addressed the question.
I'm pretty sure that was a very comprehensive answer. Thank you very much for that.
Yeah.
So I'd like to move on to the next question, which would be, How will the introduction of capital gains tax impact Malaysia's stock exchange?
I'll get this as well. So in the event that the capital gains tax is introduced in 2024 on the gains of from the disposal of shares in unlisted companies, this may lead to a temporary surge in listings on the local bourse. For example, in Malaysia, it's Bursa Malaysia. In general, private companies which are considering on listing their companies on the stock exchange or undergoing a restructuring exercise will expedite their corporate plans in 2023 before the capital gains tax kicks in. The anticipated spike in IPO in 2023 will likely to add growth to the market capitalization of Malaysia's stocks exchange. I hope that answered the question.
Yeah, I hope so too, but I'm sure that should there be anything else to be specified, the person who submitted the question will be happy to come back to us by email or whichever way possible to ask for further details. Thank you, Dal. Priya, I think this one's for you. We understand that Malaysia has 24% CIT rate. Does that mean MNCs operating in Malaysia will not be subject to GMT?
Well, no, that's not necessarily true because even though Malaysia's corporate tax rate is 24%, the 15% minimum tax rate is on the effective tax rate. So that means that effectively, provided the other conditions are met as well, that even if you have a corporate tax rate of 24% is in Malaysia, if your effective tax rate is lower than 15%, for example, if you have tax incentives, for example, or if you have losses, or certain other things that result in your effective tax rate becoming less than 15%, then the GMT may apply. And also the calculation of the GMT as per the OECD model commentary is quite complex, and there are certain adjustments that we would have to make that you don't normally do in your usual tax computations. Yeah, so in a nutshell, it's not necessarily true that because our corporate tax rate is 24%, that this doesn't apply to Malaysia at all. It remains to be seen, and it is based on an effective tax rate. Yeah.
Okay. Thank you very much. We have one more question to go. And this one would be, will the restriction of cost on private motor vehicles still apply to the tax deduction for the rent of private electric vehicles?
Yeah,
to get for you.
This one. Okay, so for the rental of private electric vehicles, the key detail for this tax deduction is to increase the limitation of the deduction for lease payments for the use of motor vehicles to increase from 50,000 ringgit, which is for a vehicle costing more than 150,000 ringgit, or 100,000 ringgit, 100,000 ringgit for the lease payment, which is for motor vehicle costing not exceeding 150,000 ringgit, increased to 300,000 ringgit in respect of the electrical vehicle. So means the restriction will not apply for electrical vehicle. But however, just take note that private motor vehicles other than electrical vehicles is still subject to the restriction of the vehicle.
Thank you very much, Vivian. So as far as I can see, there are no further questions for the moment. Well, as I said, you already provided a very comprehensive insight, and I think this is probably something to take in before further questions may come up. So as always, please feel free to submit your questions should they come to mind later on, or after a discussion with your colleagues. Just feel free to pass these on either to me or to one of my colleagues via email, and we will be happy to answer whatever comes up later. So for the moment, I'd say thank you, everybody, for attending and participating in today's webinar. Thank you, Vivian, Dal, and Priya, for your presentations. As I said in the beginning, this webinar has been recorded and will be made available online later on, so you may recap anytime you wish. And of course, as always, too, I will be happy to share the presentation slides as well upon request. So please feel free to just drop me a message and we will share the slides with you, since it has been quite something to take in. So once again, thank you very much. Have a great day. Take care and looking forward to see you next time. Bye-bye.
Thank you.
Thank you.
Thank you, everyone.